Alright, what's up everybody? So I wanted to go over real quick my strategy and how I find my executions, all the steps that I take for it, and all that kind of good stuff. So I'm just going to get right into it without an intro or anything like that. The first thing, alright, there's 3 steps that I use to find the strategy. The first thing is finding the daily bias for the day. Okay, so let's go on to replay mode and let's figure out what our bias is for today. Alright, so if we look at let's just look at like the 15-minute time frame. We could tell that we are in all-time highs. You can see there's absolutely nothing before this area, and we are sweeping all-time highs. We're making higher highs and continuing higher. There's no previous liquidity that's going to stop us and making move down from that, unless we see something, a very prominent high. So at this point, that's already one confluence that's going to tell me that we're going to continue higher. We're going to see more bullish activity. The next thing, we see that Asia made a move up, and then while London was opening, we opened above the Asia open. So it's a perfect indication that we're going to continue higher after that. Now, usually when we see a move up, we always want to see a retracement down. So we could see that London is making a move lower, making a retracement for us to then potentially move back higher. Okay, so this is already telling me, this is already 3 things that are telling me that we're going to continue higher. So I'm going to mark this off because that is already done. So finding daily bias is done for the day. Now the second step is going to be finding the draw on liquidity. This is exactly what I look for every single time before I enter a trade. So let's look. Let's go on the 1-minute time frame, and let's go to New York Open. Okay, boom. So I have 2 main draws on liquidity. One of them is going to be the sweep, and then the other one is going to be the actual draw. So the first one, like I said, is going to be the sweep. So we're talking that we want to see higher bullish activity. So what that means is we're going to have to sweep sell side liquidity. Okay, so at this point, we have a very nice and easy sell side liquidity here at London lows. And we also have potential Asia lows that we might potentially want to sweep right here. So we got London lows right here, Asia lows right here. This is a perfect example. Let's even look at like a higher time frame. Let's go on the 15-minute time frame. Let's see if we can find some sort of fair value gaps or anything like that. We could see beautiful. This is a beautiful 15-minute fair value gap right here. We could potentially retrace back into. Also, we have a bullet or a bearish order block. We could potentially also retrace back into. Okay, this is already giving me 3 confluences that this is going to be my main draw on liquidity. Something that you have to keep in mind is liquidity is like a magnet, okay? Think about magnets and how they work. I'm going to pull it up for you guys. This is exactly how I illustrate this, okay? You have to think about, I don't know how to fucking flip it, whatever. Think about liquidity as a magnet, okay? If you guys have ever played poker before, you know the whole goal is to put more money on the table of your opponents, okay? So let's just say, for example, you have a beautiful hand, okay? You're 100% confident that you are going to win this round no matter what. So you keep bluffing, you keep saying that you have, you keep telling your opponents that you have, you want them to put more money on the table. You want them to put more chips on the table. Okay, now you have to think about it within trading. Okay, this is the best way I can explain it. Okay, let's just say, for example, you're an Asia trader, okay? You're a banker that works in Asia, and you place a long position just say right about here, okay? You're gonna set your stop losses below the lows, and then you're gonna target some, some high up there, whatever, bullshit. And then let's just say, for example, a New York trader comes in and says, hey, I see that there is stop losses below this Asia, or for example, there's below this London low right here. What I'm going to do is I'm going to push price down to stop them out. I'm going to stop out that Asia trader, that London trader, for them to put more money on the table for me to take them. Okay, so this is a perfect example. I'm going to get rid of this order block in this fair value gap so it's a little bit easier to see. You have to think of it that way, that you are trying to get your opponent to put more money on the table because you're trying to give them the fact that, like, hey, I have a potential to win. So what they're going to do is they're going to get overconfident. They're going to start putting more chips on the table because they think that you have a bad hand. Okay, now at that point, you realize, or they realize, okay, I'm putting too much money on the table. I kind of need to take a step back and maybe fold my cards. They fold their cards, and all the chips that they just put on the table are now sitting on the table. And whoever wins that round takes that money for themselves. Okay, so for example, Your friend folds his cards, and now all of his chips are sitting on the table for you to take. That's exactly how liquidity works. You have to think of it that way. This is probably the best example I could give it to you. Think about as in poker. Okay, so let's turn these sessions back on, and let's take a look what happens. So we come back, see what happens. Okay, boom. This is another good example. You could have honestly taken a trade to the shorts right here. If you look at like the 5-minute time frame, we see that we have a bearish fair value gap right here. 5-minute fair value gap. We retrace back into it, close inside of it. So this is already telling me that we're going to push lower. Okay, this is a perfect example of draw on liquidity. The draw on liquidity is like a magnet. You always want to see a retracement or some other, strategy, whatever you use as your PD arrays to that draw on liquidity. Okay, think about it like a magnet. It's that simple. All right, let's see what happens. Next candle, boom, we sweep that London session low. Now what just happened? That New York trader stops out that London session trader. Now there's a bunch of money sitting on the table for you to take. Okay, that's your friend folding his hand because he's risking too much money for himself. There's no more money that he has left. So he just put all that money onto the table, and you just took that from him because you won the round. You have to think about it as like sometimes when trading you have to create scenarios for yourself so you can understand things. That's probably the best way I can explain liquidity is with those two scenarios. You're playing poker and you as a banker. So now what do? We swept that first draw on liquidity. That first draw on liquidity was that London session low. At this point right now, I'm targeting that London session high because what we talked about was that main draw on liquidity. That's where all of that liquidity is sitting. Let's just say, for example, there's a London session trader and he wants to take shorts to, Asia session lows. Okay. And New York trader comes in and says, hey, I see that there are stop losses sitting above this high right here. So what I'm going to do is I'm going to then make an execution. Let's just say he gets an execution at this retracement, and I'm going to target that stop loss. Okay, that's a perfect example right there. So let's cross this off. All right, now let's take a look what's going to happen. All right, let's just flip this around. This is going to be a perfect example for us. This is the London session high, and let's see what happens. Boom, just like that. Simple. And it keeps going higher and higher and higher after that. This is a beautiful example of how we use draw on liquidity. Now, at this point, it kind of goes into your preference and how you trade. Personally, anytime I see this exact setup, I take it no matter what. All right, I see that we have a London session low sweep. And for example, how I trade is I trade fair value gaps. So I use inverse fair value gaps. This is 1 minute inverse fair value gap right here. So we break above, we close above that fair value gap. Boom, I'm taking longs right out of this candle, targeting that London session high. And now we have a fair value gap right here that we also retrace back into. Boom, stop loss below the lows, targeting that London session high, wherever you want to target. Boom, there you go. This is a perfect example. Personally, I would go break even at this high right here. That's my break even level. Fuck. Break even. Boom, just like that. Once we go above this line right here, that's my break even. So I'll move stop loss to break even, and now I'm completely risk free on this trade, and I'm now targeting that London session high. That's as simple as that. Now, you might be asking why target session highs? And that's literally, like we were talking about it, that's exactly where people put their stop losses, where these banks and these market makers, there's billions, and I don't know how much money, but there's probably millions and billions of dollars sitting above those highs and those lows because they think that the price is going, they're going to try to target, the opposite side of the liquidity. All right. And we always have to think of this as well. Price is always trying to target liquidity because what is liquidity? Liquidity is literally other bankers being stopped out for them to then put money on the table. All right. So it's as simple as that. Let me show you guys another example because there was another decent example the day after. So for example, right here, this is another great example right here. What do we see? Let's go back to replay mode. All right, what do we see? Asia makes a move down, and then instantly when London's open, we start making a reversal. That's a perfect example right there that we're going to continue higher. Now, what else do I see? This is our all-time highs right here, which is also a perfect sign of liquidity. Liquidity is those stop losses where those banks put their stop losses at. This is a great example. So we're already making a move up. I'm potentially looking for a retracement, maybe down to this low right here, this imbalance right here. Like if you take a look at the 5 minute, let's see. Take a look at like the 5 minute, maybe like a 15 minute. All right, we see a 15-minute imbalance right here. Fair value gap, kind of like a small fair value gap. Either way, it's still an imbalance. All right, let's see if price wants to retrace back into it for us. Go back on the 1 minute, and let's see what London or Asia or fucking New York does. I'm sorry. All right, we make a move down, making a retracement back into this entire imbalance right here. Now, I want to look for longs. Okay, so I'm not going to be taking fair value gaps to the downside. I'm going to be taking fair value gaps to the upside. Or inverse fair value gaps. If we see a bearish inverse fair value gap, that's perfect entry for longs. All right, boom. This is it right here. This is exactly where I'm going long. 1 minute fair value gap. Retrace back into it. Motherfucker, I'm taking a high. I'm taking that shit every single day, no matter what. Stop loss below the lows. Targeting that London session high right there. Boom. Once we go above this line right here, this point of liquidity, stop loss at break even. Boom. That's it. That's all you need for the day. All right. Let's see how many points that is. That is 62 points. All right. If you do 62, so let's do 62. Let's just say you do, let's just say you do 5 contracts. All right. 5 contracts. Then you multiply that by 2 times 10. That's $620 right there. Now let's say you have 5 accounts. Times 5. Boom, dude, you just made someone's monthly salary on one trade that took 1, 2, 3, 4. Let's see, actually, like 8, not even 8 minutes. All right, come on, this is like, it's simple as that. Now let's see what happens after that. All right, let's just say we sweep this high, and at this point, we could see a reversal because that's a pretty strong drawn liquidity right there. We could have a reversal after that, or we could continue higher. It doesn't. I don't know. Let's see. Okay, we kind of just chop around. We honestly don't really do shit, to be honest. But you can see that we are targeting lower liquidity right here. All right, and then now we're targeting back up. We're targeting that previous liquidity that we had. This is a perfect example of how liquidity works. All right, I would genuinely spend some time figuring out how liquidity works if you're a newer trader, because that's literally what the market runs off of. It might not be, these big hedge fund traders in New York, they might not be using ICT. They're not using, fucking supply and demand, but price is literally based off of liquidity. Banks come in and stop other banks out to put more money on the table. You have to think about it like a poker game. It's as simple as that. You're trying to bluff the other guys and tell them that you don't have good cards, but you're still putting chips on the table, so they could be more confident and say, hey, I'm going to put more chips so I can make more money out of it. They end up folding their cards because they realize that, that's their stop loss. You have to think about it like that. So that's all I really have for you guys today. I hope you guys enjoyed the video and actually learned something from this. I'll see you guys within the next one. Peace out.